Okay, everyone, welcome back to the Price Action Labs YouTube channel. Here we're going to be going over a specially requested video, which is essentially scalping the Nasdaq or scalping NQ futures. So just before we begin with the video, we just want to kind of go over the ICT concepts, and then we're going to combine this with the order flow. So we have the chart from Tuesday, the 14th of January. This is an A plus setup, which I took myself on ES, not NQ, but I understand NQ is a more popular pair, right? So when it comes to NQ, right, the I use, the simple process I use involves this, right? We're looking for a 15-minute fair value gap. That is the first thing we're looking for. The next thing we're looking for is for a 1-minute mitigation or a 1-minute entry into this zone, right? So we're looking for price to enter this zone. And once we get there, we're then looking at the order flow, right? The order flow being the most important thing. So when you have these things, right, you have a mechanical approach. Now, when you have a mechanical approach, which is something we're going to go over throughout this entire video, it eliminates emotions and therefore allows you to make predictable and profitable decisions. So again, this is NQ on the 14th of January. So we need to start with a 15-minute time frame. So a 15-minute, fair value gap is what gives you overall context in the market. We're going to be going over step one to begin with, right? So as you can see here, we had a very, very large news event. And here the price gives us a 15-minute fair value gap. Now, I often get questions about how I mark out my zones. So this 15-minute fair value gap was again an A plus zone for an A plus setup. So why is that? Well, there's a few reasons for that. Well, first of all, we're analyzing the Asian range, right? So you want to look for 15-minute fair value gaps that are below the Asian range, right? The reason you look for them here is because you want them to be below this daily opening. So again, this is the power of 3 indicator, right? So our job is to buy below the daily opening, right? Not so much the 4-hour opening. If you can use the daily power of 3, you'll have an advantage over all the influencers who use the 4-hour power of 3. So that's the first important thing, right? So we're looking for the Asian range, right? Just a quick tip on the Asian range. When you see price taking out the Asian range high, and then you see price taking out the Asian range low, you need to understand what's happening in this overall cycle, right? We're seeing an enticement of early buyers, and then we're seeing an enticement of early sellers, right? This is the power of 4. So the power of 4 starts off with accumulation, the Asian range, then we have manipulation phase 1, then we have manipulation phase 2. After both manipulations are done, this is the best probability conditions you can use to trade, right? So again, we're simply combining our power of 4 knowledge with fair value gaps. Pretty simple. Now from here, we look for a 1-minute entry. This is where things get very interesting. So now when price comes into the zone, we head down to the 1-minute time frame. So on the 1-minute time frame, we're looking for price to enter this area, right? So couple of things about the entry, right? What's important to understand is this, right? So notice how prices accumulated. So we've had a pretty large range over here. This is an accumulation in price. Now, the accumulation often occurs above the zone. When the accumulation occurs above the zone, this is what we call inducement, right? So this is inducement, the liquidity that's building up over here. That is important to understand, right? So now if we continue to play price on, let's see what we end up getting. Okay, so now we're in the zone. Price is now in the zone. So this is kind of step 2. Right, so let's quickly go over our steps, right? So every single trade will follow these mechanical rules, right? 15-minute fair value gap, right? Notice how it's below the daily opening, so it's below the New York midnight opening price. That is step 1. Step 2 is that we need to have a 1-minute entry. The 1-minute entry is what you see over here. This is the 1-minute entry, just over here. And step number 3, which is the most important now, is we're going to be going on the footprint chart. And we're going to be understanding the order flow, right? So the order flow is our why, right? So it's the why behind every trade, right? So you want to understand how many aggressive buyers and how many aggressive sellers there are inside of this zone, right? So let's break this down. So here we have the ATAS platform, ATAS, and we're going to be breaking down the price action we see over here in line with the candlestick chart, right? So this is where things get very interesting. And this is where I've been coaching many traders over the last few months just to get them to understand the power of what you see in front of you, right? So when we come into a zone, when we come into a fair value gap, we are looking at these numbers over here. Now, in particular, we're going to be looking at this wick rejection into the zone, right? So again, to make things very clear, we're in a 15-minute fair value gap and we're using the 1-minute time frame to validate our entries. So what we see here is a bunch of numbers on NQ, but we're going to understand what these numbers actually mean, right? So notice how we have a lot of red over here. We have this highlighted red area over here, right? So what's important to understand over here is that we have significant selling volume, right? But if the level itself is this entire area zoomed in, when we have significant selling volume in this region, but the market fails to break below this level, what that means is that aggressive sellers are being absorbed. Now, when aggressive sellers are being absorbed, this means the zone is strong. And the reason why the zone is strong is because we see passive buyers that are popping up in this area and driving price higher. So if there's one thing you want to remember is that you're looking for the opposing market participants to fail. In this case, we see a ton of aggressive selling. If you look down here right toward the bottom of the candle, we see 2 for 0 and we see 7 for 0. This means there's more aggressive sellers than there are aggressive buyers. But despite that, the market is able to find an area of demand from this area. We're able to see demand hold, which means passive buyers have absorbed aggressive sellers. That's essentially how the order flow works, right? So again, we see the same thing over here in the markets, right? We see how prices come in and we see red delta, right? The delta here represents the ask minus the bid, right? So when you see red delta, very simple to understand, there's more aggressive market participants hitting the bid than the ask, right? So that means there's more aggressive sellers than there are aggressive buyers. Now, the same thing happens over here. We see lots of red over here. We see lots of red over here. The majority of these candles are red, and we do see some blue popping up. So what that means is that when we see aggressive sellers inside of a bullish fair value gap, that gives us confidence that the market is willing to hold this fair value gap. So with that being said, we have our overall confirmation that have been ticked off, right? So we have a 15-minute fair value gap. We are below the New York midnight opening price, hence why we have a red candle or a downwards candle. This means we are inside of a location. We have now had a 1-minute entry and the order flow has been confirmed. Now, what do we mean by order flow, right? So to quickly break that down one more time, the order flow essentially means when we're inside of this region, we're looking for some red delta. The red delta corresponds to aggressive sellers, right? These are aggressive sellers. Now, when you see aggressive sellers, mind the spelling, when you see aggressive sellers, what that means is that the market failed to break below this zone, right? So imagine it this way. Aggressive sellers are coming in, but they're struggling to break below this zone. And instead, we actually see that through the market breaking this with a body, right? So let's quickly go in and understand the candles, right? We're seeing a lot of aggressive negative delta. We're seeing massive amounts of selling volume, but they're not being rewarded. Now, when you see selling volume that hasn't been rewarded, what's really happening is that the market is popping up with passive buyers. So to quickly show you this again, we're seeing aggressive sellers come into this area, but they're failing in this region. And price proves that by breaking above this zone, right? This is what we see over here. To give us extra confluence, we are below the daily opening, which is somewhere around this region. Now, this is what gives you indication to buy because we've seen aggressive sellers fail and we've seen passive buyers pop up as a result, breaking this level to the upside. And now from here, we can take an entry here and we can be confident to have our stop loss over here. Now, again, what gives us confidence to have our stop loss over here is because in this region, we understand that market participants, selling participants have failed. There are passive buyers sitting in this level. So from here now, the question becomes, well, where do we target, right? So where I personally like to target is I like to target the most recent fair value gap, right? So we see the most recent fair value gap popping up in this region. So we see a fair value gap just over here where I have targeted, right? So this is where we target. This is kind of our first target, right? So I like to let my trades run at least a 2R to get some kind of reward from them. Now, of course, you can see price rallies up to the second resting in this area, right? So this is how you use the power of 3 with ICT concepts. It's a pretty simple concept once you understand it. You're looking for, again, let's quickly break down the formula, right? So when price gives you a fair value gap, right? So price gives some kind of a fair value gap like this, right? This is a fair value gap. Now, in order for this fair value gap to hold, right? So let's give it some context. We have a bullish fair value gap like this. You are waiting for price to come into the area and you're going to have negative delta in this region. The negative delta is not rewarded, which means price failed to break below the level, price broke above the level. So this means that this level is valid. There are passive buyers in this zone. And that's exactly what you see over here, right? So again, to quickly break that down, we use the order flow to understand that there's aggressive sellers that aren't being rewarded, hence why the market moved up in the first place, right? So this is the basics of order flow.